from in here.
So
down. Can they hear me if I turn my volume down? I guess they can't.
yes, I can hear you.
I don't know. I'm not an IT whiz. I know about houses, not volume. Hi, Tara. See, I can't hear Tara. Oh, that's because she's on mute, I bet. Okay.
Okay, is my earbuds connected?
Okay.
Good morning.
Oh, where?
All right, I'm going to turn my light on.
Okay, can you guys hear me?
Yeah.
Yep.
Yay! Good morning, everyone. How are you guys?
Good morning.
Good morning.
Thank you for joining us. Kansas City, woo woo! Oh, wait,
Who could that be? That's not your husband, is it?
that's so funny. No joke, I did not make that connection immediately. I thought we had a serious Kansas City Chiefs fan on here. I was very excited.
Yeah.
Yes, yes, yes. All right, and as we go through the presentation today, Chad is going to be monitoring our questions so we know what those are and we get all of your questions answered before we wrap up today.
I was like, oh, I have that same bed. That's because that's my guest bedroom.
Look, I almost put makeup on for you guys this morning. Almost. I considered mascara. I was very close.
Well, that's one less thing you have to do before you go to bed tonight is wash it off.
Yeah.
Hi, Jen.
Good morning.
Hi, I just wanted to say Brian's here with me too.
Nice.
Hi, Brian.
Hello.
All right, guys, well, we'll get started. I have a feeling there's going to be a few more stragglers and getting some text messages. But I'll start off by introducing us. I'm Katie with Donnelly Group Pro Smart Realty. We also have Zach. Zach, say hi.
Hey guys.
And Gina. Gina's been in the business for close to 20 years. We have collectively 22 years of experience in the Donnelly Group. And we're really excited to be doing this because we just want to really give back and give you guys some really valuable information so that hopefully when and if you're ready to buy a home, whether it's a month or a year from now, you'll kind of know how to navigate through. And then we also have Tara and Chad on. Chad is Kansas City there. Chad will be answering questions. So we're going to do it chat box style. Normally we like it more open, but just because of Zoom, we can't really do that. It's going to be too many people talking. So save your questions and then we're going to pause and answer all questions at once periodically throughout. Tara, if you want to introduce yourself really quick.
Sure, yeah, I'd be happy to. So my name is Tara Krieg. I work with AmeriFirst Financial. I'm a licensed loan officer. I've been in the business for over 18 years. I'm also a financial coach with Dave Ramsey's organization. So I help families prepare budgets and save money and really help them with all things personal finance. My breadth of experience is I worked in banking, in management, and chargeback and fraud and credit card services. So I have a really good breadth of knowledge of all things personal finance. And so that really comes into play as we're navigating credit and preparing to purchase a home.
Thanks. Sorry, guys. I'm just answering some texts I'm getting about the Zoom. But thanks, Tara. Tara's a wizard. We like to call her on our team. We love her so much, and everybody who talks with her is like, this girl is amazing. Where did you find her? So she's going to be doing a lot of the loan-led stuff, which is half of home buying, really. So she'll give you a lot of good information on that as well. So are you doing the screen share, Tara?
Yes, ma'am. Let's go ahead and dive in.
Welcome, guys.
Hey Luke. What's poppin'?
Hey, how's it going, man?
Good to see you guys this morning.
Hey, you too. Thanks for having us.
Yeah. You missed a little bit of the intro, but if you guys have any questions, just type them in the chat box and we'll answer them periodically.
Okay.
Absolutely. Thank you.
Okay. All right, there we go. Can you guys see my screen okay?
Yes.
All right, wonderful. So we'll dive in today. Was there anything else in our open introduction, Katie, that you had to cover before we move on?
I don't believe so.
All right, well then let's get started. All right, so I want to talk to you guys a little bit about generations defined. And I can't see all of your faces, but I imagine that we've got people of all different ages on the call today. And it's going to be really interesting to see how home buying has changed over time. So the first generation we'll talk about is what's called the silent generation. Those are individuals who were born between 1928 and 1945. Some of the events that they experienced in their lifetime would be the Great Depression, World War II. They also pioneered rock music, which is pretty cool. And I thought what was interesting about this, no member of the silent generation has ever served as president. And as I was thinking about this presentation today, I thought to myself, is that because they experienced such significant hardships that really nobody in that generation wanted to step into that position of leadership and deal with such massive challenging times for our country? I don't really know the answer to that, but definitely in my mind, looking back on the last couple presidencies and what those presidents have gone through with COVID and 9/11 and the housing recession and the big bailout. I mean, it's just such a massive responsibility for those in leadership leading our country. The boomers, so born from 1946 to 1964, were named for the uptick of births after World War II. As of 2016, 74.1 million baby boomers exist. And what's interesting about that is baby boomers are just hitting the age of retirement. And so we're seeing a lot of movement with baby boomers right now, downsizing and preparing for retirement. Generation X, let me minimize this over here. There we go. We're born between 1965 and 1980. So I am personally a Generation Xer. I think Gina, you probably are too, as well as many of us as we're nearing our 40s here. So 36% of Gen Xers have more wealth than their parents. I talked a little bit about the fact that I think that is largely due in part to the fact that we bought houses early on. A lot of us got married young. We started our families young. And so home ownership is something that we started earlier in life. In the 2016 election, Gen Xers and millennials made up more than half of the electorate, which I thought was really interesting. Okay, and then last but not least, millennials. We're talking a lot about millennials right now because they are the biggest pool of buyers in our marketplace. So those are born between 1981 and 1996, and they eclipsed the boomer generation in 2014. So as of 2016, there was 92.7 million millennials, which is incredible. And if they are now just for the first time starting into the home buying process, as you can see, that's going to make up a huge pool of our buyers today. Okay, so who is buying for the first time? Gen Z and millennials are accounting for 66% of all new buyers. 43% of buyers are buying in the suburbs. I would not be surprised if that continues to uptick as more people are fleeing cities and areas, you know, where during COVID they were stuck in their house and there wasn't really anywhere to go. So people want to be further out. They want land, they want parks, they want areas that they can enjoy. First-time buyers are likely to live with a spouse, and I'm even going to change the word from spouse to a boyfriend, a girlfriend, a companion. I'm seeing a lot of co-applicants, so not necessarily married, but buying with another individual. 56% have children under the age of 18. So yes, I would say that starting a family seems to be a really big motivating factor for why individuals might want to consider purchasing a home. Likely to live with parents or roommates is only 17%, so certainly a much smaller percentage of that. And then renting while they're looking. So 56% of people who are purchasing home have been renting. And a lot of times their time frame for buying is directly correlated for when their lease is coming due. So when we're doing that mortgage planning, that's a big part of that conversation to make sure that you can honor the agreement of your lease or get out if it's appropriate. And then of course not have double payments as you enter into home ownership. And then flexible in considering different types of homes. So a lot of times with my first time home buyers, when I ask that question about what type of home are you looking for, a patio home, a condo, a single family, a lot of times they just don't know yet. They wonder what they can afford first to really figure out what that looks like. All right, let's go ahead and I'll let you guys take over the 4 reasons to buy a home this year.
4 reasons to buy a home this year. Are we loading? Is this loading? Can you guys see the screen?
Tara,
Yeah.
yep, there you go. Tara, you'll have to control the
So
Oh, you've got it, my dear.
if you guys keep up with the market at all, you'll know that you've probably heard it's a seller's market right now. The inventory is really low. And everyone's kind of like, I'm just waiting for the market to drop. It doesn't really look like that's happening anytime soon. In fact, all of the statistics that we have and trends based off of data only shows it really going up. There's no reason that people are moving right now. Do you mind clicking the next one? Rising building costs resulting in higher home prices. So the cost of lumber is going up. I know Gina was really passionate about this one yesterday.
Yeah.
38 lumber packages are going up between 28 and 32%, and truss packages on new build homes are up 38%. And that definitely plays a role in the prices of new builds going up. And if the prices of new builds are going up, then the prices of resales are going to follow summarily. So, you know, it all factors into why you might want to consider buying a home this year as opposed to waiting. Keep going, Katie.
Mortgage rates are at a record low. This we're going to talk a lot about moving forward. But right now, mortgage rates are historically low, meaning the interest rate is, what is it right now, Tara? 2.75?
So a 15-year fixed is about 2.25. A 30-year fixed is running about 2.75. And if you're lucky enough to be a veteran and have a VA benefit, a 30-year fixed is in the low 2s. So it's unbelievable how these historically low interest rates have allowed for home prices to continue to appreciate and still keep our first-time home buyers in the market.
Yeah. And speaking of, we're going to touch on this again later too, but because mortgage rates are so low and the market is kind of high, it really balances out. You can wait till the market goes down, but then interest rates are going to go up. You're still paying the same amount, except for maybe with the low interest rate, your monthly mortgage might be lower.
You're absolutely right. And we're going to dive into that more in the presentation with actual real life examples, but you guys are going to be shocked how much those rising rates play a role in how much you can afford to buy.
And rent won't be rising anytime. I'm sorry, rent won't be falling anytime soon. They tend to rise every year. If you live in an apartment, you might have even experienced it before, but rent just keeps going up and up. And at least you're sure that mortgage stays the same, pretty consistent every month.
Yeah, that's really the benefit of that 30-year fixed is we call it a hedge against inflation. And I don't know if you guys had considered this, but when you purchase a home and you lock in a 30-year fixed rate, your principal and interest portion of your payment stays the same for the entire 30 years. So while rents would continue to rise slowly and surely, your monthly payment is now locked in. And boy, does that make a big difference. All right, Miss Gina, you are up.
All right. There are plenty of reasons to own a home. And I would say for most people, it's the best way and the easiest way to accumulate wealth. And here's the first, it creates long-term wealth accumulation. So when you are owning a home and you're getting into a new place, your wealth is built as the market grows. So that's really, really big. And Tara was mentioning earlier about baby boomer, not baby boomer, Gen what Gen are we? Gen Z?
Gen Z.
I don't even know what Gen we are.
Oh, we're
But
Gen
we
X.
accumulated
Gen
more
X.
wealth than our parents because we bought homes earlier on and were able to buy and ride that equity wave and then take that and reinvest it and so on. The amount of equity you can make in a home is more than you can probably save in a year because it's very difficult to save money. Plenty of tax advantages. And of course, I always say consult with your CPA, but when you are paying rent, you have nothing to write off on your taxes. When you are a homeowner, you get an interest rate at the end of the year from your bank, which says this is how much money you've paid in interest. And that, as of today, is still a tax deduction, as well as your property taxes. So you'll be paying property taxes as part of your mortgage payment. And that is also, as of today, tax deductible. Again, always consult with your tax advisor, but there's a lot of tax advantages there that you see nothing of as a renter. Rental income possibility, rental investment income possibility. One of the things I like to tell people, especially a first-time home buyer, is when you get into your first home, it is try to make your payment to what it would be as if you were renting, because you can take that payment and still continue pretend you're a renter and still continue to save money for your next home, so that if you can continue to save, then you have your down payment for your next house and turn the home that you're living in that you purchase into a rental. So you still, what was that, Katie?
No, go ahead. I didn't mean to interrupt
So
you.
it's a good way to build a rental investment portfolio.
That's especially important too with, and we'll talk about this later too, but if you're able to get into a house with little to no money down, and then you're just paying that monthly mortgage, it's very, very easy, like she was saying, to keep saving. And then when you are ready to buy your next house, let's say, you know, in that time you worked on your credit or whatever it might be, and you're ready to get another loan, get another house, somebody else is going to move in and you could turn that into rental. They're paying your mortgage for you.
And they're paying your mortgage for you.
You didn't even get into the house with a lot of money down. So
Can we go back one slide? Is that possible?
It is. There you go.
And then again, as we touched before, the interest rates are just very, very low right now. And Tara's going to talk a little bit later about how that the interest rate affects your buying power. So the fact that the interest rates are so low right now, you'll learn a little bit later on why it's so important, but that's another great reason.
Miss Gina?
I don't know, I think my screen
slide.
is, okay. Homeownership and children. So owning a home and compared with renting really leads to a better quality of life when you have children. For example, you might live on a second floor apartment and you hear the banging of the, keep your kids, keep the noise down. You don't have any of that when you are a homeowner. Cognitive outcomes are 9% higher in math and 7% higher in reading in children living in owned homes, just because it's a more peaceful sense of environment and security. There's also a lot less behavioral problems if the child resides in their own home, as opposed to having to deal with the stress of a landlord. These findings occur even when parental economic and social characteristics are considered. And the findings are similar regardless of gender, number of siblings, the location of the home. Just the fact that home ownership is more of a sense of security and stability. Now it's moving.
Yay.
So the social benefits of home ownership, 63.7% of all US households.
Oh,
Yeah, I'm having some technical difficulties here.
You're okay.
67% of US households who own their home currently are enjoying the benefits. Home ownership boosts the educational performance of children, induces higher participation in civic and volunteering activities, improves health care outcomes, lowers crime rates, and lessens welfare dependency. And basically it's because you guys have the control of power of where you're purchasing your home. Owning a home is different than renting. With the home purchase comes the pride of ownership and the sense of belonging in a community where one has a financial stake in the neighborhood. So you got the neighborhood block watches, you have like your neighbors, you always got that real sense of community and not like, oh, I'm only here for temporarily, I don't need to get to know the neighbors. Homeowners are also happier just from having achieved the American dream, quote unquote. It's a sense of accomplishment, it's a milestone, and it also entails a greater individual responsibility.
All right. And then we're going to dive into the numbers. So the renting costs versus the buying cost. And Katie, am I taking this slide? Is that correct?
Doesn't matter. I
Okay.
think you have more relevant to what you're going to talk about next. So,
Okay. So we're going to talk a little bit. It doesn't include the cost if the lease is broken, but this really is a great comparison. So if you go out and rent right now, you've got your first month's rent, you've got 1.5 times a security deposit. Usually there's a cleaning deposit. If you have a pet, they charge you a pet deposit. If you guys have rented, you look at these numbers, this probably all feels pretty familiar to you. Those numbers add up really quickly. They also charge an application fee and a credit check, at which time most of those are non-refundable, even if you don't get it, totaling an estimate of about $7,650. When you're purchasing a home, you can put for the first time as little as 3% down on a conventional loan. You also skip your first month's payment. So your first payment is deferred. Your closing costs and prepaids average about $5,000 and a home inspection is about $400. So you're paying $15,900 to purchase a home and you've gained equity right away. The amount of money that you put down, that $10,500, was an actual down payment against the house itself. And that's based on a home worth $350,000. So as you can see the difference, if you can put together that little bit of extra money, purchasing a home in the long run really makes sense. This is a simple comparison of a rent versus buy, and I think this is really interesting. So if you look over here on the left-hand side, monthly P&I. So P&I stands for principal and interest. It's the part of your payment that you pay every month that goes back to paying the loan. So that would be $1,328. We estimated $410 in property taxes and insurance. We even put in money for maintenance and repairs. So when you own a home, you don't have a landlord that's going to come fix your AC unit if it breaks or other things with your property. So we wanted to make sure that we put money in for maintenance and repairs to the property. That puts your total monthly expenses at $1,883. If you
Hey,
compare
Tara,
that,
real quick, just so everyone knows, the numbers Tara's going over are based on a purchase price of $350,000.
Oh, wonderful. Thank you, Chad. So rent comparably at $1,952 plus property taxes or insurance. Usually I see they charge you taxes through the rental, so $29. So your total estimated rent is $1,981 on year one. And then we use just a standard appreciation of rent over time based on what's customary. You can see annual rent increases of 4%. And this is based on an interest rate of 3%, which is just above market rate. So look over here on the graph to the right, the cash flow difference. So if you're renting year one, it goes up 4%. It goes from 1981 to 2060 to 21 to 22 to 23, 24. And this blue line is where that principal and interest has remained unchanged that entire period of time. In addition to not only the equity that you gain by the home price going up, when you make that monthly principal and interest payment every month, a portion of that payment is actually paying the loan down. So not only are you gaining appreciation because the home is going up in value, but you're paying down that loan, which is increasing what you stand to make if you go to sell that house down the road. Over here on the right is a 10-year comparison of what you could anticipate to make in purchasing a home versus renting a home. And it even takes into consideration the closing costs as well as the cost to sell. And where it says cash flow difference, that's how much money you were able to actually keep in your pocket by not paying that increased rent over time. So for a lot of families, they think to themselves, oh, if I could rent for the same pace it's going to cost to buy, I don't have the hassles of the maintenance. There is a ton of lost equity and wealth left on the table by paying somebody else's mortgage. So if you want more information about the comparisons that we put together for you today, I'm more than happy to provide that as well as the Donley Group.
hey, Tara, if I can interject for a second, just because
Please
you reminded
do.
me of something.
Yeah.
I didn't know this until I had our first mortgage. So I think maybe some of you guys don't know this, but your property tax, insurance, all of that is wrapped up into your monthly payment. So when you pay your mortgage, you're also taking care of your taxes. You're also taking care. So you're not, really feeling it like
Like an additional expense. It's
yeah,
all
it doesn't feel like
one
an
shot.
additional expense because it's all in your mortgage. So that just wanted to throw that in there as well. And when Tara qualifies you, she makes sure that number also includes, like, if you say, hey, I'm comfortable at 1,800 a month, she's going to make sure that that's 1,800 including property tax, insurance,
Kristen.
everything else. So
You're absolutely right. Thank you so much for pointing that out. The only portion of a payment that you'll pay separate would be a homeowners association. And we do include that in the budget. And we'll be talking more about that as we go throughout the presentation today. All right, Katie, I'll turn the time over to you guys to go over current market comparison from last year to this year.
yeah. Gina, did you want to take over this one?
Yeah, I don't mind. So part of why the market, you hear the real estate market is so hot right now, it's because the amount of inventory we have. There are very few people selling their homes right now. So where you see the active listings for sale at 6,162, usually any given time, especially this time of year, we're looking about 12 or 13,000 listings. So we have a 50% decrease in inventory. And you see the 6,162 listings, that includes 55 and older communities where, I mean, you guys definitely are not, ready to buy in yet. Also includes areas that you won't be searching in, like Ajo, Youngstown, Williams. God, there's a whole variety of towns out there in Arizona that I didn't even know existed. Waddell, I mean, there's just so many. So when you zip that down into and compress that into an areas that like you may consider looking in Maricopa County, that number of 6,100 is even less. And then you compress it down into like your price point, that's even less than that. So there might be, maybe 15 to 20 listings between 3 towns that might fit your need. So that also is what drives the prices up. And in the next little graphic there, listings under contract, it's up 23.8% because the amount of people that are writing, they're writing very quickly. They're not sitting on the market for any given amount of time. And that in turn drives the sales price up. So now our median sales price is 335,000. That's up 15.5% of last year. So people last year that were saying, I want to wait till the market drops, they're really paying 15% more. And again, Tara is going to talk a little bit more later about how the interest rate correlates with that. So that's basically what that means. So now's the time to buy.
Now's the time. Yeah,
there's at the top of the slide, the experts. So our MLS president is saying, look, guys, we're going to see a repeat of 2020 and 2021 this year. There's no question on that. The inventory is low. Things are staying the same. It's going to be the very, very similar market. And, 1 month in almost, and he is correct. We have not seen any increase in inventory or anything. The market is exactly repeating what we saw last year.
And here in Arizona, we have a lot of people coming in from out of state right now. It's crazy how many people are moving to Arizona because it's affordable, but because of that, everything's being driven up. But we're getting compact. Like we really are getting like a bigger city. And as we expand on the outskirts of Phoenix, it does get more affordable on the outskirts, but we're not really able to do new builds anymore. We're running out of space, like within our, area between
the Phoenix metropolitan area.
The whole Phoenix metropolitan area. So another reason
running out of affordable land.
Yeah.
Katie, I'll just add on top of that Phoenix Metro has been the fastest growing city in the US for about the last 4 or 5 years. So that's why it's really grown rapidly. So that's a big reason for all that.
Yep, 100%.
So the market does not seem like it's going to be dropping anytime soon.
Yeah, I mean, I think prices are always based on supply and demand. And right now what we're seeing is just a lack of homes available for the number of buyers who are looking to acquire and purchase a home for the first time. So the sense of urgency, no question about it, guys, is right now. I do mortgage planning meetings for families, and I got a text from my team member about a week ago that says, oh my gosh, I've never seen so many prospective buyers that are starting in January. You know, usually they get through taxes and we call it the spring home buying season. And March is really where we see that uptick.
Yes.
And we're seeing it early this year. And I think it's because, you know, people understand this sense of urgency as it relates to these historically low interest rates and decreasing inventory. And I'm really excited that you guys are here with us today to learn more about that. And perhaps that will spur you guys to want to look into it as well. Okay, mortgage rate projections. So interest rates are predicted to slowly rise over 2021 while remaining historically low. I want to talk a little bit about interest rates because it plays such a huge role in affordability. Just 2 years ago, I guess the fourth quarter of 2018, so a little over 2 years ago, interest rates peaked over just 5%. We're half of that today. Meaning if somebody was purchasing a home for $250,000, their payment would be similar to somebody who's purchasing a home at nearly $500,000 today as it relates to the money that they're borrowing for that mortgage. So as I really start to show you guys what those numbers look like, you're going to understand, because a lot of people say, well, it's, you know, we have this bubble, home prices have appreciated so significantly. I had a client recently who purchased a home, and when he bought his very first house, he used an FHA loan and the interest rate was in the mid fives. Well, he just bought a primary residence for over $500,000 and his rate is 2.5%. And literally he said, I cannot believe my payment is within $200 of what I was paying when I bought my very first home for half of the price. So it's just crazy how these low interest rates play a role in what you're able to afford. All right, credit and credit scores. So you guys, I spend, no joke, about 50% of all of my planning meetings on credit. And I wear two different hats. So I wear, when I'm teaching Dave Ramsey, I'm teaching people how not to get into debt. And if they are in debt, I'm teaching them how to get out of debt as quickly as possible. And I think there's a lot of misconceptions about credit as a whole. So some people think you have to have debt to have good credit. First of all, let me share with you, that's just simply not true. I know people who use a credit card, they pay it off in full every month, they haven't paid $1 in interest, and they have a wonderful credit score because credit is really about establishing a pattern of behavior as it relates to repaying your bills. And that's what a creditor is looking for. If we're going to loan you all of this money, we want to see some history of what that looks like, because as we know, the best predictor of future behavior is past behavior, and credit certainly is intended to be that. So going into misconceptions, a lot of buyers think you need a really high credit score to qualify for a home, and that's just simply not true. So, you know, right here, I need a 780 FICO or higher to buy. If you look down here, these are the percentage of homes that were sold in these credit score ranges. So 8.7% of the loans that were given were to borrowers who had a credit score between 600 and 649. 54.7% were credit scores between 650 and 699. And you can kind of see the trend. So the higher your credit score, the better the interest rate and terms you'll be offered, but not having a very high credit score may not necessarily exclude you from home ownership. So we kind of went through this. Americans believe that a good credit score is 780 or higher. It's funny, I have some borrowers who will call me and tell me their credit score is over 900. And I said, well, the scoring models that we use don't even go that high. There's a ton of different scoring models out there, and we'll talk more about that throughout the presentation today. But in 2019, the average credit score in the US is 704. And so it's certainly not anywhere close to the 780 that they believe to be good. What credit score is needed? Although there is no concrete answer to that, the credit score will determine what programs you're eligible for. So for example, a lot of first-time homebuyers want to take advantage of down payment assistance or first-time homebuyer grants. In order to take advantage of those, generally speaking, you need a middle credit score of about 640. Now, for a lot of our families, the very first time I sit down with them, they may be at 580 or 600 or 620. One of the things that we do is we run scenarios on simulators that are based on the actual scoring model that they use for mortgage lending. And we give you a step-by-step action plan on what you need to do to get your credit score where it needs to be. Are all credit scores the same? No. So if you monitor your credit on Credit Karma, that's actually what's called a Vantage 3.0 score. And mortgage lenders don't use that scoring model at all. So although Credit Karma is a wonderful tool to monitor the integrity of the data that's appearing on your credit report, the actual score itself is not necessarily going to be anywhere close to what your score is going to be when your mortgage lender pulls it. How big of a role does that credit score play? Man, it really makes a difference. So in order for you to qualify for an FHA loan, which is a government insured loan, so Federal Housing Administration, it simply means that the government is going to insure it in the event you default. You need to have at least a 500 credit score with 10% down. Now, the interest rate on a scenario like that, guys, isn't going to be anywhere close as competitive as a scenario with a borrower who has a credit score in the mid sixes or higher. So although we can write loans with a credit score as low as 500, my goal would be to help you raise that credit score and get the best terms possible. 580 is really the minimum credit score for an FHA loan when you're putting just 3.5% down. Okay, conventional loans. So conventional loans, when you're a first-time home buyer, let you put as little as 3% down. And the minimum credit score required before you can really start to qualify for anything is around 620. But when you're looking at a conventional loan, at 620 credit score, the interest rate would be quite a bit higher than somebody with a 680 all the way up to a 740. If your middle credit score is above a 740, you're going to be eligible for the best rates and terms available in the marketplace. So this is, I thought, really interesting. And if this isn't a perfect indication that we learned from our experiences. So age bracket 18 to 29, the average credit score is only about 659. 30 to 39, it jumps up to 677. 40 to 49, we're starting to get things figured out, 690. And then ages 50 to 59, 713, and 60 and higher tend to have really good credit. They figured it out, they pay their bills on time, they've got some money saved, and they're just in a better situation overall, generally speaking. Average FICO score by income. This is really interesting too, because you can have younger people that make quite a bit of money and have no problem paying their bills every month. So the low income, their average credit score is 664, moderate income is 716, middle income 715, 753, and of course the high income is 775. So the more money you make, the easier it is to pay your bills on time every month. Down payments. So 20% down is not required. I get that a lot. People are in rentals saving to purchase a home, and meanwhile, home prices have risen, using last year as an example, over 15%, while they've been trying to save money that wasn't necessarily required to get into a home. So you can see down here the percentage based on those generations that we talked about, how much money they're putting down. So millennials, 24 to 38, we're putting down, you know, less than 3%, and then you can see 3 to 5%, what percentage, and then it goes up. So the silent generation, more than 20% down. Well, that's simply because they've been buying and selling houses, and they're taking the equity, as Gina mentioned, that they've earned on the prior sell, and they're simply rolling it into their new home purchases, which is wonderful. Just over half of buyers, 52%, put less than 20% down when they purchase a home. Younger buyers put down less than older buyers because they simply have less money. Okay, what should you know about down payment sources? So there's a variety of different sources that a down payment can come from, and here are just a few. So one of them, of course, is just your standard checking and savings. Private gifts and loans. A family member can give you a gift, and that is an acceptable source of funds. The other thing that I've seen recently, which I think is a lot of fun, is when people are getting married, instead of asking for presents, because oftentimes some of these people have lived together and they already have all the basic necessities that a young couple might need, is they'll actually open up a checking or savings account for a down payment on their very first home. And your visitors who come to your wedding can put money into that account, and it's pooled gift funds. And you can use that for a down payment on your very first home. So gifts are perfectly acceptable. Retirement accounts. I've got a lot of families right now who are using a 401k loan. So they're borrowing against the money that they've saved up. They're paying their self back the interest. So the difference between a 401k loan and just simply withdrawing from your 401k is that the interest that you're paying on that 401k loan is actually going back to you. And you borrow based on the prime rate, and it's usually prime plus a margin. So around, let's say 4.25. So if you pull that money out of the retirement account to loan it to yourself for a down payment on a house, then you're paying yourself back the interest and it goes back into your retirement. There's no tax consequences and there's no penalty. Now, we always recommend that you consult with a CPA and check with your retirement account. One of the issues with taking a loan against your 401k is that if you left that job, you only have about 60 days to repay that loan, which can be really challenging if you took $20,000 out and then you make a job change. So make sure that you know all the information about possibly pulling from a retirement account. A second or piggyback loan, they used to do what's called 80-20s. So the first mortgage would be 80% to avoid private mortgage insurance, and a second mortgage would take you up to the 100%. In today's market, a lot of those second mortgages don't go above 80%. And so the piggyback loans we're not really seeing much of in today's lending environment, if you will. If you are a veteran, first, thank you for your service. But secondly, veterans have a loan that offers them 100% financing and they're not required to put anything down. So if you're a veteran, no reason to wait, definitely give us a call today. Private and government down payment assistance program. Go ahead, Gina.
Oh, no, I was just looking at Luke's expression there.
Private and government down payment assistance programs. So there is a couple different grant programs available in our marketplace that home buyers are using all the time. One of them is called Home Plus. It offers grants anywhere from 3% to 5%. The interest rate that you pay on those loans are a little bit higher than you would if you paid your own down payment, but the money they give you after you've lived in the house for 3 years is completely forgiven. So for individuals who it's a matter of not being able to buy if they can't pay their own down, a grant may be a great way to help them expedite how quickly they can get into a home of their own. And then the last one is just innovative loan programs. So I sit down with families and we do what's called mortgage planning, and we look at your equity across the board. So in some cases, if we've had somebody who had a car that was owned free and clear, that's actually considered their own asset that has equity, and they were able to take out an auto loan and use that as a down payment on the new purchase. And they felt more comfortable with that than a 401k loan. And the interest rates on auto loans right now are quite inexpensive as well. So just lots of really neat strategic and innovative ways to help you understand how to leverage what you have to be able to get into a home today.
Tara, I want to add to when you're talking about the DPA, the down payment assistance and the grant programs, with today's market, with the increase in the equity that the buyer will be gaining, the higher interest rate is definitely going to be offset, because that's going to be equity that they wouldn't be gaining if they continue to rent until they paid.
No, you're absolutely right, Gina. I think the other thing to touch on too, guys, is that we are in a historically low interest rate environment, and we don't know exactly when rates are going to rise. But what we do know is that even the interest rates that are a little bit higher than current market rate are still lower than they were a year ago or 2 years ago. So waiting to buy so you can save up money instead of using down payment assistance, well, interest rates could rise the same amount anyway, even if you're paying your own down payment. So it's really important to understand the potential cost of waiting. All right, about down payment assistance. So buying a home is exciting, but for many first-time buyers, there's one thing that stands in the way, and it's that stinking down payment. An option to consider, and we just touched on it, is that down payment assistance. These programs differ state by state and county by county. So it's really important that your lender and you sit down and figure out which ones you may qualify for. In addition to that, they also have income restrictions. So for example, in Maricopa and Pinal County today, you can make $109,000 a year as a household to be able to be eligible for some of those different down payment assistance programs. And then some of them are a little bit lower at $62,250. But here's a really neat strategy, you guys. Let's say husband and wife both work, and combined, they're over the income limit for down payment assistance, so they think that that's not an option for them. Well, we don't have to use the income from both of you in order to purchase. If one of you can qualify with the income that you make that's under the income limit, we're able to simply remove the income from the other spouse if you can still qualify and proceed in using the down payment assistance. So this is where that mortgage planning really becomes quite valuable in you truly understanding all of your options. What is the minimum contribution required of the applicant? Well, if you're using down payment assistance, the minimum contribution is 0, but for first-time home buyer, 3% down if you're not. And then we talked a little bit about income limitations based on borrower's household income. And then what geographic restrictions does a program have? So I'll give you an example. There's a loan program out there called USDA Rural Housing. It offers 100% financing. The interest rate is in the low 2s, and the mortgage insurance is very inexpensive, about a third of what it is for FHA. However, that particular loan program has both income restrictions as well as geographic restrictions on where the home is located. Currently, the eligible area starts out, if you're looking at the East Valley, for example, you have to go right on the outskirts of Santan Valley as you're heading into Florence. So it's called USDA rural housing because it's for rural areas. So eligibility is based on the population of that particular zip code or community. So if you have questions about some of those loan programs that may have geographic restrictions, definitely reach out to us because they're very specific based on the area that you are interested in. When I do my mortgage planning and I talk about, what area might you want to live, if they say Mesa, Gilbert, Chandler, we don't even talk about that loan program because it's not something that's going to be applicable to them. But if they say, it's really all about affordability and we don't mind going further out in order to be able to obtain a home loan that would allow for no money down, then all of a sudden USDA becomes a great option to discuss.
So Tara, Lauren had a question and she was wondering about the teacher program. On those grants, do they still give an extra % for teachers?
They do. Yep. It's called
Can
Home
you
in
talk
5.
about that just a little bit?
I can, I'd be happy to. So Home in 5 offers an additional 1% of assistance to teachers, firefighters. I'm trying to think exactly what it all includes, but like
First
paramedics,
responders.
first
Yep.
responders. Yeah, there's a list of people that fall under first responders, but paramedics would be an example, police officers, firefighters. And so if you are any of those and are interested in using down payment assistance, definitely give us a call and we'd be happy to share with you how being in that profession is going to get you just a little bit more assistance, which is wonderful.
And is it still the home in 5? Is it still the 5% of the loan amount?
It actually depends on the interest rate. So there's grants as low as 3% where the interest rate on the full loan is going to be lower, or 4% or 5%. So there's 3, 4, and 5. Mm-hmm.
I want to give a real life scenario about this down payment assistance. I just helped a really young couple just starting off. Were newlyweds and they got their down payment assistance. They found the perfect little place for them. They're very happy with it, but it was an older place. So they kind of got concerned about maybe potential plumbing issues that the inspector found, and they were on the fence. So we negotiated their closing costs. And the only thing between down payment assistance and getting their closing costs covered by the seller, the only thing they paid for to get into their house was about $400 for their inspection, which we're going to talk about later what those costs are, but $400 for the inspection, $500 for the appraisal is all they paid to get into their house. Their first month was deferred, so they closed and they didn't have even a payment until the next month. So they took what would have been their mortgage that month and put it back into savings. So they made money. They were actually able to save more money than they had before getting into a house, their very first house. So that's a really good example of how down payment assistance, it does sound too good to be true, but it's true.
Yeah, it's true, Katie. I've had buyers who, and granted, we're in a seller's market, so you may not always get your closing costs covered. But I have had buyers, no question about it, who have gotten their security deposit back and purchased a home with virtually no money out of pocket, which is just incredible. So if you want to learn more about these programs, we're more than happy to kind of take your specific scenario and show you what that would look like. Okay, what lenders look for? We're going to go through the 4 C's. So credit worthiness, this is really important. Lenders are looking at your character as it relates to repaying your obligation. So responsible attitude towards living up to your agreements. Will the debt be repaid? Credit history will show us if your bills are paid on time, which shows good character. And creditors also look for stability. How often do you change jobs? I actually have a gentleman I just did a mortgage planning meeting with this morning, and he works in the restaurant industry as a chef. And as you guys know, they have just gotten killed in the last year with COVID. And so not to mention the fact that in general, chefs in the restaurant industry do tend to move around quite a bit. Well, he's had 5 jobs in the last 2 years, even though he's been a chef the entire time. So FHA is going to require that he be on his job, his current newest job, for 6 months before he's eligible to buy. So when we're talking about changing a job, it's really important that you have a conversation with the lender if you know you're going to be purchasing in the near future. He said to me, you know, I wouldn't have changed jobs if I would have known that this was going to cause a delay in our home purchase. And it's always really hard to find this information out after the fact. So if you have questions about a possible job change, please consult with your lender first. Capacity. So this is the financial ability to repay the loan with present income. So they're looking at what we call your debt to income ratios. If you're just a regular W-2 employee, the lender looks at your gross monthly income. So how much do you make before they take out taxes and insurance and your health benefits and your 401k contributions, et cetera. And they say how much of that income is already committed to other payments, like student loans and car loans and credit cards and things of that nature. And then that's how we figure out how much you can afford or qualify to purchase a home. Creditors will want to know if there are financial resources to add another bill to the monthly expense. So if you're living in a place, and I'll just give you an example, and this is coming up a lot right now. You're living in a place that's $1,200 a month, and you're looking to purchase a home, and your payment's going to go up to $1,600 a month, although you haven't been saving any money. So we're looking at what you have in your bank account, and essentially you're spending every dollar that you make right now while your rent is only $1,200. Then we're going to sit down and have a conversation about residual income. Okay, let's look at your budget today. How much are you spending? You know where we find the majority of that money is going in eating out, recreation, and entertainment. So if we want to allocate more money to the housing expense, then we want to make sure that you guys are going to be comfortable making an adjustment in your lifestyle to create that extra cash flow needed to put towards the house payment. Capital, additional owned property worth more than the debt. So looking at kind of what your net worth as a whole. Is the creditor fully protected if you fail to make the mortgage payment? That's where mortgage insurance comes in. That protects the lender in the event you quit making your mortgage payments. And if the credit is unsecured, are there funds to cover the debt? So for example, when you get a car loan, it's a secured loan. It's secured because if you don't make your car loan, they're going to come back and repossess your car. Whereas when you take out a credit card, it's unsecured credit, where if you don't make your payment, there's nothing for them to come back and take back from you to get their money back. So they're really looking at what your capital position is. And then collateral. So we do an appraisal on the property that you buy to make sure that the property itself is worth the value of the loan that you're taking out. So we want to make sure that the property pledged against the loan we're giving, that home is worth the value there. And then what assets might you have to back up your ability to repay? So if you have a higher debt to income ratio or other things like you move around in your job more frequently, having reserves can be a great compensating factor. So if you've got money in checking savings, or even you're putting money into a retirement account, that can really help. Okay, to ensure a smooth journey on the road to homeownership, you guys, this is really important. There are some costly detours to avoid. Number one, maintain your employment at your current job. I've been in the business 18 years, and I can't tell you, it's happened more than 1 or 2 times that somebody has made a job change while we're under contract to close on a new home purchase without discussing it with the lender first. So
Hey,
please
Sarah.
yeah.
Can I, with these do's and don'ts, I want to just touch back, because I know you've mentioned it a few times on your mortgage planning meeting.
Yeah.
All of my friends, and I think a few of you even on here who mentioned, yeah, I think I want to buy a house in the next few years. You know, the first thing that I always say is not like, I'll be your realtor. It's like, if you need to talk to Tara. Like if you have any kind of idea that you think you're going to buy a home, it doesn't matter if it's next month, doesn't matter if it's next year, doesn't matter if it's 3 years from now, if that's your goal, talk to Tara, because these do's and don'ts are so important. And you could actually be hurting yourself by paying certain debts first, putting certain amount of money in the bank. It could actually impact you negatively if your long-term goal is to buy a house. So
Yes.
Tara's mortgage planning meetings are completely free. It's complimentary. She does it over Zoom now, I think, right, with COVID.
I do.
My husband and I, we used Tara to buy our first home. And when we had our mortgage planning meeting, I was shocked when she said, oh no, you guys just have a few months worth of like work to do on your credit and then you're fine. Like, you know, my husband at the time had some debts that he had to pay off and things like that. But I mean, it was just so helpful. So I wanted to say that because I don't think people understand how great it is. Like, it's so great. So these do's and don'ts are really important. And she talks about that privately with you if you'd like as well.
Yeah, and I appreciate you saying that, Katie. And I want to elaborate on the employment thing real quick, because I think these are things that as we're entering into our career and into the workforce that nobody really tells us. So when you become a self-employed individual, I want to give you an example. You're out there exploring the job market and you've got a couple different job opportunities. Let's say one of them is in sales and the other one is just a salaried position. And the position in sales is great because you have the potential to make more money. So in your mind, you're thinking, okay, this is awesome. I have the potential to make a lot more money, and that's going to help when I go to purchase a home. Well, if the majority of your compensation structure is commission, you actually can't use that commission income until you've been in the job for 2 years. Well, if you don't want to wait 2 years to purchase a home, then your strategy to purchase a home might be that you're going to look for a salaried position initially, because that's going to allow you a guaranteed amount of income each month. So let's say, for example, the two options that you have are a commission job where you can make 90 grand, but they're only going to give you a guarantee of 25 or 30. And then you have this salaried opportunity that's going to give you 60,000, and that's a guarantee. So if you take the commission job, when I go to qualify you for a home loan, if you haven't been in that job for 2 years earning those commissions, then I'm only going to be able to use your guaranteed draw or your minimum wage. And for a lot of people, they say to me, oh my gosh, I had no idea I had to be in this job 2 years before I could use my commissions to qualify for a home. So that's an example, and certainly just one of many, where you want to know out the gate what you should be looking for if it's part of your home buying process. Any questions about employment? Because I think that's a really big, hot topic, and I would love the opportunity to answer those questions for you during our homebuyer workshop today. So just put them in the chat, and then Chad will be monitoring that, and he'll let me know if I need to stop and answer those questions. Okay, number 2, keep all existing credit cards open. You guys, this is really important. For some reason, when people are planning to purchase a home, it's not uncommon for them to try to pay off their credit cards and close them all out. That can actually lower your credit score. So yes, pay them off, but do not close them out. The other thing is pay off collections, judgments, and tax liens, but only the ones that were reported in the most recent 12 months. If you've got collections, judgments, and things like that that are old from your past, I want you to consult with me first before you would go and pay those off, because it's counterintuitive, but they can actually lower your credit score. You can take an old collection that's 4 years old and hasn't reported, and now all of a sudden you pay it and it brings the last report date to current and your score drops 80 points. You're like, what the heck? I'm trying to fix my credit, not hurt my credit. And oftentimes, if the collection's older than 12 months, you may not even be required to pay it anyway. So you want to make sure that the things that you're doing as it relates to getting your credit in tip-top shape are at the recommendation of a professional who understands the consequences of those actions. The next
Tara,
one.
we have a couple quick. We
Yeah.
have a couple quick questions.
Okay, wonderful. Go
so
ahead.
one would be: would paying off any school loans be considered a don't?
Oh, no, you can pay off those student loans, if you have the ability to do so, please do so. It won't adversely affect your credit. Those are installment loans. And by completing the repayment of those student loans over time, you'll actually see your credit score rise.
I just want to
All
share
right. Oh, go ahead,
quick,
Zach. Sorry.
just a quick story about me paying off a few credit, like you were saying, don't pay off your credit card or don't pay off a loan like that. Granted, we just purchased our house last year, so I wanted to wait a little bit as you instructed, but I had a credit card that I left open that I didn't really use that had a monthly or a yearly payment on it. And then I also had a personal loan for a car loan. I paid both those off a couple months ago and my credit dropped like 70 points. So,
Yeah.
but and it's going back up, but still it just
Yeah.
shows how drastically it can just closing that because of the credit history.
Zach, I'm really glad you brought that up. I actually had a guy who, so when we run these simulators, we have the ability to advance out 2 years. And so the simulation is looking at the calculator. I use the word algorithm, they're one and the same, but is looking at this calculator and it's recognizing that when I just advanced a year, the guy's auto loan actually paid off and there was no longer an installment payment. And his credit score dropped like 28 points. And because he didn't have any other credit to kind of supplement that. So again, credit's tricky. And so you definitely want to make sure that you're consulting with a lender and that we're using these simulators to really be our guide as we're trying to leverage your credit score and put you in a position to take advantage of the best terms and interest rates available in the market.
One more question before we move on. How do jobs, so I assume multiple jobs, look to outsiders or credit checkers? And the little more detail, I've been in the same job for 6 years, but will be moving locations under possibly a new LLC, but same owners in a few months.
Okay, that's a great question. So first of all, if you have no ownership interest in the business and you're not self-employed and you're the employer, this is how I'm understanding the question. So if I'm not correct, please unmute yourself and let me know. But if it's just that the owners of your company are changing, that happens pretty frequently where they'll be, now they're doing business as a different business name or something along those lines, but they keep your seniority the same, then there shouldn't be any adverse effect on how we would qualify you. You would want to make sure that you're still going to remain a W-2 employee and that your income structure would remain the same. And then the question about multiple jobs, I want to touch on that. So and this happens all the time, you guys, now with people who are doing like side gigs, where they're driving for Uber, they're doing Uber Eats, they're doing meal delivery. We cannot use income from multiple jobs unless you have a 2-year history of working 2 jobs and 12 months uninterrupted at the same 2 jobs. So if you're trying to use income from multiple jobs, it's really important that you understand the time frame required to do that. Did that answer your question? Did I understand your question correctly?
Yeah, that was me. You answered it. I have owners that are gonna add to their current brand and expand, but it will be under a different name, and my W-2 might have a different name on it.
Yeah, that would be okay. As a matter of fact, that happens pretty frequently. And I would ask the question to them, does my seniority, my hire date? So for example, if we order a verification of employment, do they consider your hire date as your original hire date, which I assume they would? Or are you moving over to a new company where they would consider this a new job for you?
Okay. Perfect.
I actually had, yeah, you bet. I want to use an example real quick, and it was kind of unique, but it was a property management company that had a guy full-time, and then they actually opened up a division under the sun to bill the maintenance on the properties that they manage separately. And the way that they set up the books, it actually ended up being considered 2 separate jobs. And it actually ended up being an issue for him in that scenario. So in your scenario, ask the right questions, but then if you're really knee deep in the home buying process, make sure the lender's working directly with your employer, that what we assume is happening is in fact how that's playing out on the books behind the scenes. So, okay. Did I get all the questions answered on the do's? And then we'll move into the don'ts.
It appears so for now.
Okay, wonderful, guys. I'm so sad I can't see all your smiling faces, so bear with me. Don't apply or open any new credit of any kind. This is really important. I've had clients who their lease was up on their automobile and they traded in and got a new car loan. I've had it where they're under contract and a holiday comes up and there's some smoking deal at Home Depot or Lowe's where they can get 0% interest to buy their appliances, or furniture stores. So when you are in the process of purchasing a home, I use something called freeze frame. So your life is on freeze frame as it relates to your credit and your obligations. And I don't want you applying for any new credit until we get through the home buying process. Don't max out or overcharge your credit cards. 30% of your score is made up from what's called utilization. And it's a simple calculation between the balance that you're carrying in comparison to the line amount. And this happens a lot on small credit cards. So if you are new to credit, and when you got your first credit card, they only gave you a $300 or $500 limit, it's not uncommon that they're charging that credit card up almost to the max month over month, even though they might be paying it off in full. So if you're in the process or preparing to purchase a home, you want to keep those balances on those credit cards low. Don't consolidate credit card debt without consulting with your lender. So I'll give you an example. I have 2 credit cards. They each have about $5,000. I get a credit card offer that says I can have 0% interest for 24 months, and I want to take advantage of that. I'm going to move the balance on my other $5,000 credit card to the other one, and I'm going to max it out. So now I have one credit card, 0% interest, $10,000, $10,000 limit. And I have one credit card that has a 0% balance. Your utilization is now 100% because the only credit card being factored into that algorithm is the credit card carrying the balance. So it's really important that you don't consolidate debt into a credit card. That wouldn't be an installment loan. An installment loan is looked at different. An installment loan, let's say you're getting a personal loan to consolidate your debt, and it's going to be a 60-month payment and it's a fixed payment over time. That will not adversely affect your credit the way it would if you consolidate credit cards from one credit card to another. So again, I know it's a ton of information, but with the proper guidance, you can get this right as you prepare to purchase a home. So we want to be a resource to you. So don't hesitate to reach out, even if it's a general question. And then last but not least, don't make large deposits into your checking or savings account. So the lender has to document and source any deposits into your checking and savings account the 2 months leading up to home buying to make sure that the money that's in the account is an acceptable source. So I can't tell you how many times that erroneous deposits into the account have caused issues for home buyers. So an example of that was I had somebody who sold a quarter horse. Now it was quite a bit of money and they deposited the money into their checking account. It was cash. They had no proof of ownership, no proof of value, and they had a cash deposit. That money, which they intended to use for the down payment on their house, was not an acceptable source of funds. So we had to back that money out, and all of a sudden they had to go get a gift from a family member. Now, regardless of behind the scenes, if they then take that money and they pay that family member back, it just creates a lot of chaos and stress during your home buying process that could have easily been avoided. So aside from traditional payroll deposits or standard reimbursements, if you're thinking about making a large deposit and you're not sure it's an acceptable source of funds, again, please reach out to your lender first. Any other questions about this screen? I know it's a ton of information before we move on.
I don't see any in the chat box, but.
Okay. The process and key questions. The Donnelly Group, you are up.
Yeah. Gina.
Yes. So
Gina has gone through the process hundreds of times, guys. She knows this like the back of her hand.
So it's interesting. This chart kind of does it like a clock, starting a little bit over. It's a little confusing to me, but hopefully you can follow along. And maybe I'm just dyslexic. But the first thing you do is meet with your real estate professional. Fortunately, Tara has touched on a lot of stuff here, so a lot of stuff that might have been cloudy in your head is probably coming to life. But there's so much more than just step one, and which is to get pre-approved. But after you meet with Tara or your lender, I mean, Tara knocks it out of the park. I really don't see any reason to talk to anybody else. But then you meet with one of us to start your home search. What I'd like to encourage everybody to do, even today, after this little class is over, go to our website, www.donnellyarizona.com. You can actually search for homes there. And our new website allows you to set up an account, kind of similar to Zillow. And you can search using a map search. You could search using specific criteria, city, town. The reason why I'm directing you there as opposed to Zillow, number one, Zillow is now a brokerage. They are not operating the way they used to. And because then we can, whether it be me or Katie or Jared, me, Katie or Zach, we can actually log in and see what kind of houses you're saving as a favorite. So in the future, when you decide to start your home search, they could take a look, or we can all take a look and see what kind of home it is you're actually liking or what you're looking for.
And Zach went ahead and put that website in the chat box, or you can find it on our social media as well. So
perfect. Thank you, Zach. And then once you do start your home search, the first step to getting into the home is making an offer. So one of the three of us, or all three of us, however the dynamic is going to work, we'll get you set up. We'll write the contract. We'll discuss the terms. We'll discuss what we're going to think it takes to get the offer accepted. And then is that something that you're comfortable with? We have to be really, really competitive in today's market. So sometimes you might have to venture outside of your comfort zone just a bit. But if you don't feel comfortable, we'll just back it off a little bit, but we'll get you the right guidance that you need. And then after we get your offer offer submitted, then the negotiation starts. That's when the back and forth, will you do this? Will you take this? And that goes back and forth, not too long until we can come to an agreement on terms. The next step after that is opening escrow. So escrow is that third party who's going to help manage the file. And when they're going to get you from the start to the finish up until your loan document signing. They're going to get you title commitment, make sure there's no liens on the home, make sure you're not buying anything that maybe has a tax lien on it, or the seller has, is delinquent on certain things. They're going to make sure that you're getting a nice clean title. So what you're buying is free of encumbrances and any kind of clouds. You're not going to want that. And the lender's not going to allow you to have that anyway, but that's what they do. They're also a neutral third party. So when you open up your escrow, when you get an offer accepted, you are required to put a small deposit on account with the title company. Title and escrow, I'm using that, but it's synonymous. They will hold your money, but that money that you put, whether it be 500, 1,000, whatever it is that's agreed upon, that actually goes towards your down payment. So that is not in addition. That's not like money that you're not going to see in the end.
And it's 100% refundable if you need to back out of the house for any reason.
Inspection reasons, for example. And I think we're going to talk about that a little bit after, Katie.
I think there is a section,
okay.
Yeah.
Then after we get through all our appraisal and inspection, which is part of our, so as Katie just mentioned, there's going to be some inspections. Sorry, I didn't realize that was on this slide. So once you get under contract, you're going to have a home inspection. The reason why we have these inspections, they are not required, but they are very, very highly recommended, because we don't want you to get into a house without, just by trying to save $400 or $500 on inspection, because when you get into that house, if there happens to be a roof problem or an air conditioner problem or a plumbing problem, we want to discover that up front and see if we can get the seller to correct any of those items for us. So during the first 10 days of your inspection period, if something like that comes up, you do get your earnest money returned to you. So, and then the other thing that we're going to have is an appraisal. An appraisal, Tara mentioned it earlier, it's to make sure that the value of the home is actually acceptable to the lender. So if you're purchasing a house for 200 and you happen to say, I really like this house, I want to offer 300 because I don't want to lose it and I can afford this payment. Well, that's not going to appraise. So going over that high in this situation is not going to be any benefit for you unless you have $100,000 to write check out of pocket. But the appraisal is to protect you, to make sure that you're buying something that the bank, that is, how would you phrase that best? Basically, that you're getting something.
basically that the lender wants to make sure that they're not loaning more on the property than the property is worth.
Exactly.
So it's an opinion of value is what it is,
That's
based
what I
on
was looking
on
for.
comparables.
Yeah, and it's just basically the appraiser saying that, hey, this is what I think it's worth, and the lender says, great, let's go ahead and get this done. And then the last step is closing, and that's when Tara's company sends a loan document, title company, everybody goes into the or title company to sign their closing docs, and when that is done, that's sent off to the recorder's office for signature, and when it records, that's when you get your keys. And that's basically
So I want to go back really quick to negotiations. So there's sort of two different times that we as agents can get into negotiations on your behalf. There's before you have an offer accepted. So that's figuring out the price that you want to pay. Of course, we have that conversation with you. What is this house valued to you? Do you really want it? Or is it just like a meh house? I would take it for this much money. So once we put that offer in, they might counteroffer. They might say, hey, we'll accept this if you can do this, this, and this. So then after you get your inspection done, and like giving the example that Gina just gave, let's say there's a roof issue, or there's some kind of, I don't know, whatever it might be, anything, you can go back to the sellers and say, hey, I know that we made an agreement on this much, but I'm in my 10-day inspection period and I can change that agreement, or I can negotiate again that agreement because you're in that 10-day inspection period to walk away. And the sellers might say, sorry, not doing it, not willing. And you say, well, it's not worth it to me, I'm going to walk away. Or the sellers might be in a position where they really need to sell, they're really motivated, and they're like, fine, just get it done, whatever we need to make this move forward. So you have to kind of think about what kind of leverage you have. And of course, Gina, Zach, or myself will help you through that process.
Yeah, having a really strong negotiator on your side, like the Donley Group guys, makes all the difference. It's a very competitive market, and understanding the motivation of the seller and how to navigate that conversation and go in strong can really make the difference of getting your offer accepted or not.
All right.
All right, what you need to know about the mortgage process. So what's needed to qualify in today's market? So we need to establish where your down payment's coming from. We need to go through and do income verification, asset documentation, and credit history. So when you apply for a mortgage, you'll be asked to submit an application, and then you'll get a list of documents that we're going to ask you to provide to us. So the ones that are most common would be a recent pay stub, the most recent year's W-2. If you're self-employed, we're going to need to see a history of tax returns and a year-to-date profit and loss statement to establish your income. We'll need the last 2 months bank statements to review your deposits, as we discussed. And then the other thing they look at on bank statements, you guys, is to see if you're making payments that aren't on your credit report. This has come back to bite buyers before. They didn't disclose, I actually make a car payment for my sister, or I'm actually paying the IRS every month because I owe them taxes from 2 years ago. If you make reoccurring payments that are not on your credit report that appear on your bank statement, you need to disclose that information to the lender. And then of course, they're looking at your credit history. So they're looking to see if you've had on-time payments in the last 12 months and what your overall credit position is. And then last but not least is that impartial third-party appraisal. That's done through an independent third-party company, and the lender orders it. So it's not something that the buyer can shop around for. The cost of an appraisal is typically the only thing from a lender's perspective you're asked to pay out of pocket prior to closing. For an FHA appraisal, that cost is $465. Or I'm sorry, for a conventional appraisal, the cost is $465. For an FHA appraisal, it's $490. And for a VA appraisal, and this cost is set by the VA because it's their VA appraisers, it's $600. So appraisals range from about $465 to $600 depending on your loan type. All right, ladies and gentlemen, the Donley Group, wants versus needs.
Yeah, I'll take some of this. So
Okay.
it's important, you know, when you start to do your home search, to kind of sit down and, you know, I like to do that over a conversation and kind of sort out what your wants and needs are. Typically you have some criteria like oh, it has to be a 3-bedroom. You know, we have 1 kid, maybe we want an office, or, you know, it has to be 2-bathroom, or it has to be in this location, or, you know, and kind of figuring out what your should haves and your absolute wish lists are. Like perhaps it's, I can share an example of myself when I was looking for my home. Needed to be a 3-bedroom, 2-bathroom, and I wanted a pool. But I thought it was, I should have a pool, but it was important for me to be in the location I wanted to be at. And, you know, you can always add a lot of these things later. And I think you have to put it into perspective as, you know, getting your first home, building that equity so that maybe 3 to 5 years down the road, you can actually purchase your dream home, you know, that checks all of your boxes. So just figuring out like what you absolutely need to have to get started and then what you can build upon later. Do you have anything to add to that, Katie?
You're on mute.
Sorry. I do, yeah. Just like Zach said, like you don't need to be searching for your dream home as your first home. People always say, oh, my forever home. And at a younger age or as a first-time home buyer, like your forever home, you might not get into for another 5 years, 10 years, and that's okay because you're building leverage getting into this new home. I'll give you another real life example because I like that. I have a dear friend and client that I just helped. She sold her first home, which was a condo. And at the time she loved it when she purchased it, but you know, over years, she's like, well, I don't really like the stairs anymore. I have dogs. And so she decided to sell her home and get something better. And she didn't even realize when she started the process of selling how much money she was going to make. Because she got in when interest rates are low, she went from a condo to a single family home with a pool, put money in her pocket and enough to renovate her new home. Mm-hmm. She has a backyard for her dogs now. And they're so much happier. She's like, I don't, you know, and she still is like, this isn't my forever home, but it's a lot better than my last one. And I know my next one's going to be better because I can gain more equity with this one.
Guys, I'm in my 11th house and I'm not in my forever home yet.
But, you know, she was able to put a ton of money in her pocket, still keep her mortgage the same because they had money in their pocket, they put a higher down payment on this one, got a lower interest rate on this one. So she was, you know, really happy that she kind of like, I don't want to say settled because they liked their condo, but she kind of settled for her first house knowing she was going to get into a better one. And she did.
Yeah, that's a great example. All right, 4 tips for success when making an offer.
Gina?
4 tips when making an offer. So
I would say in today's market, act fast. If you see something that checks like even 3 of your 5 boxes, you have got to get out there and make the best, strongest offer as quickly as possible, because the houses, guys, they are not sitting. Literally, a house that's listed at 8 o'clock in the morning, by 8 o'clock at night, these agents have like 14 and 15 offers. We've literally, I think our record was 19 offers in a 24-hour period. I was getting phone calls. I listed the house on a Friday and I was getting phone calls on a Sunday from agents saying, hey, we saw this house Friday afternoon and my client's getting ready to write an offer. Too late, it's already gone. And they were like, what? That's because they were not informed agents. We are informed agents. We know what's going on out there. And we know that if you like something, you have to literally strike while the iron's hot. And then again, be prepared to negotiate, because if a house is listed for 300, don't be surprised if you get a counter offer for 305 or 310. At that point, you can decide, hey, I feel comfortable. No, I don't feel comfortable. It'll be conversation with Tara. How much more does this do to your payment? It'll be conversation with Katie or Zach or myself. Do you think this house is going to have a hard time appraising? And then we all take it from there. But that is the most important. Those are the most important tips for making a successful offer right now.
For affordability right now, something else I want to make sure is considered is how much are you comfortable paying? So a lot of lenders, not Tara, but a lot of lenders I notice with clients that I've worked with, they're always like, well, I'm approved for $2,000 a month, but I'm not comfortable paying $2,000 a month. I don't know if I could afford it, but that's what I'm approved for. So that's what we're looking for. And we'll start our home search at a really high dollar amount. And every house they see, they're like, I don't know. I mean, I really like it, but like, can I afford it? And then I'm like, well, what lender did you use? How much, how did you get that approved? And I like Tara because she works from the top down. She's like, where are you, what dollar amount are you comfortable with? Dave Ramsey says, what is it, 25%?
25% of your net take home pay.
So Dave Ramsey says 25%. Is that a number that you're comfortable with? Let's start there. Let's figure out how to get you approved for that number, something that you're comfortable with, because you might want to go on a date once a month. You might want to take a vacation once a year. You don't want to be.
You might want to put money away for your next house.
Yeah. Or for retirement, Yes. I think that's, you bring up a really valid point. And I think this is a great time to really talk about that. So when a lender is evaluating what you qualify for, they do not see all the other things you pay that are not on your credit report. So at one time I had 4 children in daycare, and the cost of my daycare costs exceeded my mortgage payment. Guess what? When I would go to apply for a home loan, my lender didn't find out how much I'm paying in daycare, or perhaps I have kids that are in competitive sports and they travel, and I'm spending $3,000 a month on sports and cheer and things of that nature. Those are not things that a lender is going to see. So when we sit down and we talk about affordability, I'm going to talk to you guys about what you feel you can afford. And I can't tell you how telling that statement is, because I have people who are making $11,000 a month that don't want to spend more than $1,500 a month. They could technically qualify for a $3,000 mortgage payment, but they would never even consider spending $3,000 a month on a mortgage. So definitely when you are thinking about preparing to purchase a home, I want you to think about that question. When a lender asks you, what are you comfortable paying every month? Make sure you know at least a general idea within a couple $100s. I think we'd be okay with anything between $1,800 and $2,000, or $1,400 and $1,600. But, I think that if you're not prepared to make a major lifestyle change and you're not saving any money and you're going to significantly increase your mortgage payment, you're setting yourself up for failure.
Regardless of the type of equity you're going to make in a home, you don't want to be house poor, and you don't want home buying process to be a miserable experience. You want it to be a positive experience. And I'm going to cite myself as an example of why what Katie is saying is really important. When I bought my first house, I was 22 years old. We went to the lender, we got pre-qualified, and the lender said, you can afford $160,000. And I'm old.
At the time, buy houses for that much.
We went out. Actually, the lender said we were qualified for 158, and the house we saw was 160. And the lender said, "Oh yeah, we can do those numbers." Guys, we never left the house. We had this great house, but we couldn't go anywhere. We couldn't go out to eat. We couldn't go to the movies. My kids were little. I was like, oh crap, we got to buy diapers. Can we use the other side of this diaper? Because we were flat broke. We lived there for 5 years, and literally we had to move out, move into an apartment, and reset ourselves for 2 years to save. So it's really important that you do what you feel comfortable with.
Yeah, don't let a bank tell you how much you can afford. That's the most ludicrous thing that I've ever heard. A bank is going to create some criterias to have boundaries to protect themselves. But at the end of the day, nobody knows your spending patterns better than you. So make sure that you're in the driver's seat when it comes to that.
Tara is, I will say, sorry, can you go back? I have a couple. Tara is also, she has taught financial peace for a long time. She has a class coming up. And that's why, in her profession as a lender, she really takes into account affordability for her clients, because she does work, or not work for, but she does teach Financial Peace University. So if you guys are interested in her class coming up in March, we can give you details on that as well. One other thing about this slide is to make a solid offer. Right now in today's market, since inventory is low, I just want to remind you that you might not get your first house that you put an offer in on, and that's okay. It's okay to look for a little while. It's okay to be comfortable trying to find, make an offer here, see if it gets accepted, make an offer there. And then once you find the one you want, that's when you really have to decide, am I going to put more down? Am I going to try harder? But it's all like, it really is a learning curve for everything. So it's okay not getting your first offer accepted, especially in today's market.
And Tara, Jen has a great question. She wants to know, can you pay more than your monthly payment towards a mortgage? For example, if my mortgage is $1,500, but I want to pay $1,700 to gain equity, is that possible?
Absolutely. You can prepay your mortgage without penalty at any time. And if you're somebody who gets paid every 2 weeks, a bi-weekly payment, taking your mortgage payment and simply dividing it by 2 and paying it every 2 weeks will allow you to make one extra payment a year, taking years off the mortgage. So definitely highly recommend that. And when we go through Financial Peace University, we talk about when it's appropriate to start paying down the mortgage. One of the things I really want to caution you guys on is that if you still have consumer debt, rather it's student loan debt, credit cards, auto loans, and you're not fully contributing towards your retirement account, and if you have children, if you haven't started the college saving process, it's really not necessarily appropriate to start prepaying your mortgage. So there's great strategies to help you guys build a solid financial foundation. So make sure that you've got somebody in your corner that's helping you make those decisions. I just talked to a girlfriend who was going to start prepaying her mortgage, but her second home her daughter lives in is on a 30-year fixed rate mortgage at a higher rate. I said, why don't we refinance that other mortgage into a 15-year, take the money you were going to be paying over here and pay over here. We saved like $47,000 in just spending 10 minutes together, strategizing the most appropriate way to increase, equity and get that mortgage paid down over time. So if you are thinking about home buying and you're just not quite ready, please feel free to join our Financial Peace University virtually. It's a 9-week series, and we're going to give you all the information you need. So when you step into home buying, you feel well qualified and ready to go. Okay, things to consider when viewing properties.
A lot of new home buyers just don't know what to ask. So we just put together a little list of questions of some things that you should consider when you're viewing a home for the first time. Is the house sold as is? Are the sellers willing to make repairs if needed? So as agents, we are able to connect with the selling agent and we kind of try and get a feel for them through communication. So those are the kind of questions that we ask when we call agents of properties that we look at. Monthly cost of HOA. We're going to talk a little bit more about this on the next slide. And I know Tara already touched on affordability and HOA, but HOAs, sometimes they're not expensive. Sometimes they're very affordable. Sometimes they're very expensive. So you just want to be aware of that. Should we buy a home warranty? It is in the contract that we send. Will the buyers be purchasing a home warranty? You don't have to know because we can always change it, but it is something to consider. Is everything new in the house? If everything is new, maybe a home warranty you can get away with not having, or at least not adding on like some additional stuff. And we can always provide you with information on home warranties as well. Versus, I didn't finish my thought. If there is a home that you're purchasing that's a little older, the appliances are older, they look like they might break soon, that's when a home warranty is going to come in really good handy. I bought a home warranty on our home and we've used it 4 times in the first year we lived there. So it paid off itself. You pay like $60 every time somebody comes out. We've had an electrician come out and fix stuff. We've had pool guy come out and fix stuff, and it's like what would normally be really expensive isn't. So I think it's super helpful. What is the age of the roof, AC, water heater, pool pump? Definitely want to know how long they've been being used for so that you can get an idea of how long they might last for, what their lifespan is left. And then school district. So of course, if you have kids and you want to make sure that there's good schools. Oh, I missed one. Air traffic, busy roads. So look out for all of the things that might be considered a nuisance, power lines, etc.
Okay, perfect.
Yeah, a couple other things to consider on your home search. If you're looking for a detached house, a condo, or a townhouse slash patio home, here are a couple pros and cons to them. Pros to the condo or townhouse would be included pool, maintenance, landscaping, and then oftentimes they'll include the water, sewer, garbage in that. The cons of that are going to be a higher HOA, and that HOA is factored into a debt to income ratio, which Tara will touch on here in just one second. And then detached home, pros are going to be your lower HOA, a private lot, and then the cons of that are just going to be taking on other responsibilities such as yard maintenance, pool, and etc. Tara, do you want to talk a little bit about the HOA and that's factored in?
Yeah, absolutely. So condos, HOAs can really be quite expensive, ranging anywhere from maybe $150 as high as $500 or $600. I think Gina, you have one recently. How much is the HOA on that condo?
We're actually getting ready to sell it. It's almost $500 a month. It's $475.
Okay, so
There's
I
two.
just, yeah, this is kind of wild, you guys. I want to show you something. If you take $475, when you are borrowing at current 30-year fixed rates, you're going to spend about $4 a month per $1,000 you borrow. So stay with me. $4 a month per $1,000 you borrow. So if this particular home has an HOA of $475, if we divide that by $4 a month, that's $118,000 in buying power that you're going to lose to allow for that HOA in your monthly payment. Now, when you're talking about $118,000, let's even just take $75,000. Gina, what would a buyer be able to get at 300 versus 375? Is that a big difference in today's market?
Huge, gigantic. In some towns, they might get a pool, they might get an extra bedroom, they might get a third car garage, they might get something remodeled versus non-remodeled.
So it makes me a little crazy when a lender will give a buyer a pre-approval letter that says you're pre-qualified for a home up to 300,000 without any specific criteria for taxes, insurance, and HOA. So when we sit down and we do your mortgage planning, we say, okay, in order to keep your payment around $1,800 a month, these are the estimates that we've used for taxes, insurance, and HOA. And every house that you look at is going to be a little bit different in order to keep that monthly payment at your target monthly payment. So if you're looking at a condo that has a large HOA of $475 a month, what you qualify for on that property is going to be significantly less than what you would qualify for a single family residence that has no or a low homeowners association each month. And what's crazy about that is I've had families that buy in these master plan communities like Eastmark or Cadence, Fulton Ranch. There's like so many different ones. And then they don't even end up using the amenities. And I think COVID has really brought that out. I've had so many families get frustrated that they're paying all this money in HOA and they're not even allowed to use their gym or their swimming pool because of COVID restrictions. Now, when they bought that house, COVID wasn't even a thing perhaps, and they hadn't even considered it. But now that it is, it's completely changed their perspective about having a backyard swimming pool versus a community swimming pool, about having a home gym versus a community gym. So these are some of the things that we want you guys to be aware of and we'll educate you about through the home buying process. Any questions about HOA? Okay.
There are none listed.
Wonderful. What about closing costs? This is really important. So closing costs are also called settlement fees and will need to be paid. These fees are charged by people representing the purchasing, including the lender, the real estate agent, and other third parties included in the transaction. The great news for you guys is that when you use a real estate agent to purchase a home, you do not have to pay that fee. So that's great. It's covered by the seller. Closing costs are typically between 2 and 5% of the sales price. And here's what's interesting about that. So closing costs really don't vary significantly for a house that's $800,000 or $150,000. When you get a loan, the processing, the underwriting, the appraisal, the majority of those costs are the same for all borrowers, regardless of how much they're borrowing. So when you talk about closing costs as a percentage, It's not always accurate. So generally speaking, I would say that you want to look at closing costs. They're going to run you about $5,000 in lender fees and title fees. Any way to avoid closing costs, work with the lender and real estate agent to see if there's any ways to decrease or defer those costs. There are no closing mortgages available, but they end up costing you more in the end. So you can take a higher interest rate in exchange for the lender giving you a credit or rebate to help with those closing costs. But when you look at what you pay with that higher interest rate over time, definitely costs you more in the long run versus just having a good game plan to save for those closing costs up front. Katie mentioned the negotiations during the home inspection. It's not uncommon for a buyer to accept a credit from the seller in lieu of those repairs being completed. And then we can use that credit towards your closing costs. So you don't want to go into the home buying process expecting that. That's just a bonus if you can make that work. But generally speaking, sellers right now are not paying buyers closing costs, and it's going to be important in our mortgage planning to save and prepare to pay those. Home buyers can also, go ahead.
So getting back to the closing cost, Tara, and like paying a little bit higher premium to have the closing cost coverage, would it be a fair statement to say that someone can get in using, Katie used that renting versus owning, the $7,000 you need to get in versus the $15,000, which included the closing cost, 5,000
Yes.
of that was closing costs. Would it be a fair statement to say that someone can get in using the higher interest rate to get the closing costs, but at the rate the market is increasing right now, they can refinance and have those closing costs removed, not closing costs removed, but get the lower rate if the rates stay the same?
That's a great question. Yeah, that's a great question, Gina. So generally speaking, you're not going to be eligible to refinance for about 6 months after you close. And there is a cost to refinance. It's about $2,500. And although it can be financed into the loan, we don't want to do that unless we have to. So it's something to keep in mind as an option for sure. A lot of times in those cases, we'll actually, let's say you save for down payment, but between down payment and closing costs, you don't have enough to cover everything. We actually would then look at down payment assistance first, and then secondly, look at that higher interest rate with the rebate, simply because the down payment assistance oftentimes will give you more money. So when
is the interest rate significantly higher on that?
It's about 1% per quarter percent in rate, but it just depends on your loan program. So we would really go through that with you. And for every 1% rates go up, it's going to reduce your buying power by 10% of the sales price. And so if we have to raise your rate to cover your closing costs, you're going to qualify for less anyway. So
that would be, we don't set that much then.
Yes. So it's really going to be about the right strategy for you. I can't tell you guys, there's no one way is the right way. When I sit down with each individual buyer and I put together a customized plan for them, each plan is unique and different based on their particular scenario. Home buyers can, go ahead.
Oh, I was just going to say, while we're kind of on topic, or you can answer it after the slide. One thing that I just noticed is not in the PowerPoint, and maybe you can touch on it really quick, Tara, is what discount points are and how that can potentially assist somebody, especially if they're doing something like where they're not putting a lot of money down and maybe their interest is higher, and how they can get that back down.
Okay, say that one more time, Katie. You asked about discount points.
So discount points, how that can help people, especially maybe if somebody isn't as qualified to get that very low interest rate, and how they can purchase their interest rate to go back down.
Yeah, that's a great question. So if I mentioned before that your credit score plays a big role in the interest rate that you are offered. So if I'm working with a buyer that has a lower credit score, but they want to get that interest rate down to what perhaps a credit it would be for somebody who has a 740 or higher, they can actually pay additional closing costs up front in the form of what's called points to help offset that adverse pricing adjustment for their credit score or their loan to value. In addition to that, when you're looking at discount points, you can usually buy the rate down about a 0.25% per 1% of the loan amount. So if it's a $300,000 loan, it would cost you $3,000 to take the rate from, let's say 3% to 2.75 or 2.75 to 2.5. And what we do is we look at the break even. So we say, okay, how much more is it going to cost you up front? When are you going to break even on that money that you paid based on the savings in the monthly payment? And what's the potential long-term savings? So sometimes discount points certainly can make sense for a buyer, especially if getting that rate down is what's required to get them qualified for that particular loan scenario. But it really is unique to everybody's individual situation. So you would want to make sure that it's at the recommendation of the lender that you're doing that. I've had buyers who paid points 2 years ago and they're refinancing at a lower rate today, and all that money was wasted. So historically low interest rates, I feel more confident in those interest rate buy downs, but it really depends on market conditions. Okay. So objective, the plan is to live in this home for many years. Strategy, since loan payments will be made for many years, perhaps the best strategy may be a fixed rate home loan. I want to talk a little bit about that, and this is certainly a great slide to touch on. So in the past, in a higher interest rate environment, adjustable rate mortgages might make sense, because if rates are high and we project they're going to come down, in an adjustable rate mortgage, you don't have to refinance in order for your interest rate to go down over time. Well, the opposite is true right now. When we have historically low interest rates, I'm not writing any ARMs, because we know, with the past being the best predictor of the future, that rates are going to go up. And so right now, a fixed rate, regardless of if you're going to be in the home for 3 years, 5 years, or 10 years, is certainly our recommendation. Okay, the plan is to pay off the loan before the kids head off to college. A shorter term loan, such as a fixed rate 15-year, can be a good fit. The payments being made will assist in building equity more quickly. So a 15-year amortization allows for the interest rate to be anywhere from 1/4 to 0.5% lower than a 30-year fixed rate. It also accelerates how quickly you get that loan paid off. Now, for my first-time home buyers who still are working on contributing towards retirement and saving money and paying off debt, oftentimes we'll go into a 30-year fixed rate, and our strategy is, as we get these other debts paid off, we can reallocate that money as a principal reduction against the mortgage and still get it paid off in an accelerated fashion. The plan is to have a budgeted fixed payment each month. The fixed rate offers a principal plus interest rate that remains fixed throughout the life of the loan. So we kind of already talked about this. The benefit, rather it's a 15-year fixed or a 30-year fixed, is that principal and interest portion of your payment never changes. Now, real quick, I want to touch on the fact that Katie mentioned, when you make your mortgage payment, it not only includes the principal and interest of the loan itself, but it also includes your homeowner's insurance and your property taxes. Those are the two pieces of your payment that can fluctuate over time. Property taxes, if your home value is going up, will also rise with the value of your property. And then homeowner's insurance can also go up over time. So just be mindful, the portion of your payment that's fixed, which is the majority of it, is the repayment of the loan itself. And then the taxes and the insurance get reassessed year over year, and they change what's called your escrow payment. And the escrow payment gets adjusted every January based on what it needs to be. So there's sufficient funds in there to pay your property taxes and your homeowner's insurance on your behalf. All right, that was it, you guys. We want to open it up to questions about anything in the presentation that we haven't already touched on, but we want to thank you for your time and being with us today. We certainly hope that you learn something that makes you feel better prepared for your home buying experience.
Tara, in case anyone has any questions for you privately about maybe mortgage planning or anything, how can they get in contact with you?
That's a great question. So my website, if you want to take a minute and write it down, is tkteam.us. So www.tkteam.us. And then my office line is 480-344-1951. And if you'd like to schedule a free consultation to do some mortgage planning together, you can do so by contacting my office and getting scheduled on my calendar. I really encourage you guys to do that. Whether you're 3 months out, 6 months out, or a year out, you will walk away feeling much better informed as to where you're at and what you need to do to be ready to buy. And as Katie will attest to, people who are coming in thinking they're doing mortgage planning for the future, rather it's a year out or 2 out, sometimes they're surprised to find out they're actually well positioned to purchase today and may decide to buy sooner than they thought. So really encourage you guys to get in and get educated so you're making the right decision. Sitting on the sidelines unnecessarily, no doubt, will cost you a ton of money in the long run.
There is a question here from Jen.
Okay.
I've heard that most homes are selling for over the asking price. That's true, as it's smarter to have a lower down payment and then some extra money that can be used to come out of pocket if the home appraise is lower than the offer.
Jen, you're my favorite question of the day so far. So that is a
great question.
It's a great question.
Terrible answer that very
and
well.
homes are going for over ask, and we have strategies going into home buying to address that. So as I mentioned before, you can put as little as 3% down as a first-time home buyer, but let's say you saved 10% down. So what happens in that situation is we say, okay, it has to appraise for a minimum of this amount of money in order to have 3% down to the appraised value. And then what I do is I just tell you what the difference in your mortgage insurance will be. So I'm going to take a minute. I don't feel like I properly addressed private mortgage insurance, and I want to take just a second, if you guys don't mind, and share with you a little bit more about that. So private mortgage insurance is something that protects the lender when you put less than 20% down, in case you default, because they've shown over time that if you don't have 20% equity, if for some reason the home went to foreclosure, the lender would lose money. So what you pay for that mortgage insurance is incrementally higher as the loan to value is less. So rather you put 5% down, 10% down, or 15% down, the less you put down, the more cost the mortgage insurance is. I just went through this exact example with a buyer who's going to be hitting the streets to purchase a home. And what we did is they're planning to put 10% down, but I gave them mortgage insurance costs at 3, 5, and 10, and said you could go as high as $12,000 over ask and waive the appraisal, and you would still be in your budget for what you wanted your monthly payment to be, and you would still have sufficient cash to close based on the budget that we've talked about. So we'll really help you guys understand that. You also have the option to buy out the private mortgage insurance. And what that means is, instead of paying monthly for mortgage insurance until you've built up that 20% equity, you can actually pay a one-time cost at closing and completely buy it out. So if you've ever prepaid anything like your car insurance or your homeowner's insurance or a cell phone, you know you get a discount by prepaying. Well, the same is true with private mortgage insurance. So it's about a third of the cost if you buy it out up front as what it would be if you pay it over time. So in this particular scenario that I was looking at, it was only about $2,200 more in mortgage insurance for this particular buyer if the house didn't appraise. And so when they heard that, they were like, oh my gosh, that's amazing. We thought we'd have to pay $7,000 to bridge the gap, and that just wasn't the case. So understanding how going over appraised value is going to affect you is going to give you the confidence to make a solid offer and be competitive, so you're not missing out on homes that you otherwise would have been able to secure had you properly understood how it affects your financing.
Got it. Thank you.
You're welcome. Any other questions? Okay, well, we would love your guys' feedback really quick, and I encourage you to be totally transparent and honest. This is the first time we've done a homebuyer workshop virtually. Thank you, COVID. Normally, this is more intimate. It's face-to-face. We're sitting in a conference room or around a table. We're eating together. We're sharing stories and really diving in more intimately to your personal experiences. Do you guys feel that this was valuable? Do you feel that even though it was virtual, it was still a valuable use of your time?
You.
I do.
I do. Well, for those of you who took a minute to give us your feedback, and please feel free, like you can send us an email, Katie can call and touch base with you, but we would just love your feedback. This is our first time doing this, and hopefully it was valuable, but any feedback that you give us that would even allow it to be more beneficial to you guys in the future, we'll take that and run with it.
if you did find this valuable and would like to refer back to it or share it with somebody who you think might get some good information out of it, we did record it. We can send that to them, and we can also send the PowerPoint to anyone who would like it. So
And we
just
could probably post it to our YouTube channel.
yeah,
Yeah.
that's a good call. All right, thank you
All
guys.
right.
Well, like us on Facebook and follow us on Instagram for some more updates and about the market and great real estate tips that we drop every now and then. And thank you for coming.
Thanks,
Sounds good.
guys.
Thank you
Have
very
a
much.
wonderful Saturday.
See you guys later.
Bye, guys.
Take care. Did I leave?